To today, our compound annual rate of return is more than 14%. So 14% per year, which is a little above the S&P 500. Now, we aspire over time, our minimum hurdle rate of return is 15%. So we're somewhat shy of that. The wealth destroy.
Cathie Wood, CEO of ARK Invest, explains her conviction-driven approach to investing in disruptive innovation. She highlights Tesla as ARK's top holding, driven by the shift to high-margin robo-taxi platforms, and emphasizes breakthroughs in multiomics and CRISPR gene editing as transformational for healthcare. Wood rejects claims of an AI bubble, noting strong cash flows and lower valuations versus past tech bubbles. She remains strongly bullish on Bitcoin, viewing it as digital gold and a new asset class, while favoring long-term, disciplined investing over emotional market timing.
Articles really pick a peak in time, early 21, and compare it to a trough in time in late 22. And it is true that the decline was quite severe, but that leaves out the perspective that during the previous year, the COVID year, our performance, this is for ARKK, our flagship strategy here in the US, because we weren't in Europe at that time, but ARK, which drives costs down in new technologies, that interruption in growth was quite serious. But now we're on the other side of that. And we honestly don't think we'll see another 2021 again. We might have a pandemic. I do call it that in Europe and actually the US. But in terms of research, we've moved from genomics, which is all about DNA, to include RNA, proteins, methylation, metabolomics, in something called multiomics. What we believe and what we include in that category is the convergence among various sequencing technologies. I was managing money back then as well. And so I saw a period of craziness. IPOs that would go up are actually getting more and more questions on conference calls about their investment spending. The investors in those stocks are used to very high cash flows, rising cash positions, and that is changing. In fact, the return on invested capital in these companies is starting to move down because these are such huge projects that will pay off over the long term. And we do believe they will, but most investors are shorter term than we are. And they're getting a little concerned that they're not going to get their share repurchases now, their profits now, their dividends now, to move higher and attract more flows as prices go up. We tend to be liquidity providers in that kind of time. For example, and because we post our trades every day in the US, you can see that recently we have been selling Tesla. Tesla is reaching the high end of a 4-year trading range. It's our largest position. Our confidence in it is very high. Our return expectations for Tesla are very high, but we have seen it trade in this range for 4 years, and it might settle down after this. We are selling some Tesla as others are chasing it, and we are buying into digital assets, or crypto as others call it, the point where I think scarcity value as institutions move in is going to drive the price higher. And then the third revolution is actually what I just said. This is a new asset class, and institutions have to consider it because the correlation of returns among crypto assets versus traditional assets is very low. And so to put Bitcoin and other digital assets into a portfolio, well-diversified portfolio, will increase returns per unit of risk. And that is what institutional investors are always seeking. 5%. I think the last one at its worst was down close to 75%. Today, we're down 30-ish, a little over 30%. And we are beginning to think that institutions have been waiting to build positions, waiting for this 4-year down cycle. And therefore, we think that the downside from here is not very significant. Just to give you a little, to dimension that a bit, right now, I think today we're at about 86,000 as we are recording this, this video. If you don't change your wallets over, then to a more protected status, you will be vulnerable to a hack. Now, there are many wallets that have been lost, many Bitcoin lost, I should say. So that's still a juicy target. And so we're going to keep our eyes on quantum. And we've done an awful lot of work on it recently. Brett Winton, our chief futurist, has been getting so many questions that he's been forced to answer the question policy, trying to crush inflation, which was in the double digits, would take away an important role that gold plays, which is store of value, preservation of wealth, preservation of purchasing power. And that's exactly what happened. Gold went down from roughly $850 to $350 over, I don't know if it was a decade, but it was a very long period of time. And I think we're going to see something moving down. And if we're also right that the dollar is going to start moving up again, and then the dollar will be as good as gold, why do you need to hold gold? And you can get a double benefit if you're in the right kind of stocks in the equity market, dollar-based stocks. So you'll have the dollar going up and the stocks going up. So we, obviously, and you have to consider the source. This is all we do. We would shift away from gold and other precious metals into, stocks focused to have a higher weighting in that category than, say, older people who are depending more on retirement savings for day-to-day living. So they want much less volatility and more certainty. So they probably want more fixed income, so bonds. And then, of course, there are commodities. That does round out a portfolio. In the equity, an unmet need. The way the traditional asset management world works is very matrix-like boxes, mid cap, small cap, large cap. We are all cap. And they have sector-based portfolios, and they think of us more like technology. But that's not how we think of ourselves. We are technologically enabled innovation, which cuts across all sectors. So we're much better diversified, I think, than many people understand. When the market's going down, they look at their portfolios going down every day and they say, I can't risk it going down anymore. And they sell at the lows. That's what typically creates the lows. Or they see strategies doing really well and they say, I don't have any of that in my portfolio. They get what we call here FOMO, fear of missing out, and they chase. And that often leads to, so that's interesting. The other one, however, was 21 and 22. And this is a good illustration of, what you just asked me. In 2020, we could do no wrong. And our fund was up 150%. And toward the end of 20, I remember it was at Christmas on a Bloomberg show with Eric Schatzker. I said, keep your powder dry. And what that means, it's a cowboy term. That means don't do anything here. Technologically enabled pure play innovation in their portfolios. And so we became more aggressive. But I will say, when you say lonely, I think we bonded together as a firm. We weren't lonely. We actually doubled down on our research, and we began to strengthen each other by saying, wow, we have to get out there more and tell these stories and wake investors up, because unlike the tech and telecom bubble, where people threw money, investors, speculators, everybody threw money. Well, I have to tell you, I'll just tell you how I'm positioned now, because it's the truth. All of my financial wealth, excluding ARK, the company I own, excluding real estate, and I have much more in the financial world than in real estate, I would do what I'm doing now. But you have to consider, I have the knowledge and the conviction, and I've learned you cannot be emotional in markets. So 100% of my financial assets